Hello, everyone. We're back again. My name is Ben Jessel. I'm a contributor to Forbes.com with a history in blockchain since about 2014. And today we're running a panel on digital assets. Very excited today because we have representation across the full gamut of digital assets. From the top, we have the asset providers. In the middle, we have those that are the proponents who are building the standards and also building the infrastructure. And then we have the actual consensus algorithms and the infrastructure that connects into the liquidity pools and the issuers today. So a full stack today, which is very exciting. It means that we'll have a breadth of experience and areas to talk about. So I'm going to introduce the panel to you now. We're going to start here with Sheila Warren from the World Economic Forum. We've also got Monica Singer from Consensus. We have Henry Elder from Wave Financial and Arthur Brightman from Tezos. So I'll let each member of the panel just briefly introduce themselves, and then we'll start the conversation.
Sure. Should we go in order? Sheila, do you want to start first?
Yeah, go in order.
Sure. Yeah, happy to. Hey, everyone. I am the head of blockchain, digital assets, and data policy at the World Economic Forum based in San Francisco. Thanks for having me.
Hi, I'm the South African lead for Consensus, and what I created 20-something years ago, I transformed the South African financial markets from physical, meaning share certificates in pieces of paper and checks, to a total electronic financial market. So I've got the experience of what happens when you have to convert something that people have been doing for 100 years and bring them into the digital era. So now I'm doing the same, but in the blockchain world.
Awesome. And I am Henry Elder. I work for Wave Financial. I look after the distribution of our financial products. We have a number of funds under management, and we also have a separately managed account platform for high net worth investors and family offices who want to build their own bespoke exposure to digital assets and cryptocurrency.
Hi, my name is Arthur Brightman. My background is in finance, robotic statistics, and I'm also a co-founder of a project called Tezos.
Fantastic. Good. So I think we'll start off just by setting the scene around digital assets, tokenization, and that kind of whole piece. Tokenization has certainly been kind of a relatively new phenomenon. I think a lot of it started to emerge after the ICO craze, when there was a renewed interest in, rather than having utility coins that necessarily weren't backed, to actually start representing assets, real world assets, but using the benefits of the blockchain in terms of the fact that decentralized, could access liquidity and have lower cost for issuance, in order to be able to represent assets, which would take out the cost and improve distribution. Turning first to Sheila, certainly in your work, where you've been heading up blockchain for the World Economic Forum, I know we've seen a range of standards come out recently in the toolkit that you've published. You're very busy on central bank digital finance, currency. You've been looking at this kind of in a very broad sense. I'd love to kind of hear your thoughts around what you're seeing in the market about where there's kind of demand for certain digital assets, what digital assets appear to be gaining traction, maybe some of the fallacies that you're seeing that kind of need to be explored as well. And kind of where are we kind of from your kind of macro perspective?
Yeah, sure. Happy to weigh in on that. I think we are seeing a tremendous amount of activity in this space, which is unsurprising. We're seeing it across the spectrum. We're seeing it in digital assets, digital securities, digital payments, and digital currencies, which are obviously four distinct things. And I would say we're seeing the most action right now in digital currency. Not just CBDC, central bank digital currencies, but also stablecoin and other kinds of currency options that are out there, including, I think, a renewed look by some of the institutional players at crypto, at pure crypto. So that, I think, is a bit distinct from the digital asset question. But I think to your point about tokenization, Ben, I hesitate to use the word democracy right now, because I think there are a lot of definitions of that term. But suffice it to say, I think that there is a lot of interest as we exit at some point this pandemic and enter a period of economic recovery. There's a lot of interest in more equitable allocation of access to capital, for whether it's for kind of opening up traditional venture models, or even providing sort of small holders, SMEs, more access to capital. And obviously tokenization can support that, can support the creation of this really long tail of capital access that can engender the renewal of SMEs in our society, which we know are really suffering right now during this time. So a lot of it, I think, is pandemic oriented right now. Our work is obviously focusing a lot on pandemic recovery, pandemic response right now. And that, I would say, is the sort of immediate, what we're hearing up from all over the place that we think is going to get a lot more traction as we begin to open things up again in society.
I think it's a good point to bring in Monica, because Monica, I know you've got extensive experience with Africa, from having lived in South Africa and all the work you've been doing there. How are you kind of seeing kind of adoption, I guess, initially kind of around kind of Africa and the subcontinent around digital assets? Do we see this as a way of kind of leapfrogging some of the kind of traditional infrastructure, like we saw with cell phones moving, cutting out fixed line phones? Or is it actually kind of slower to adopt, or are there some particular edge cases here?
The reality is about South Africa. In South Africa, we are still very conservative. Why? You know that saying that what made you successful in the past will make you successful in the future. And the problem is that we have a very sophisticated financial market in South Africa. Truly, we were categorized by the World Economic Forum for many years as one of the top financial markets in the world. Auditing standards, accounting, the banking sector, very sophisticated. So what's happening is that all these CEOs that are over 50 are hanging on to the idea that I've been successful. Who are you to come and tell me that you want to re-engineer what we've been doing so well? But the reality is that the new world order, it's happening right in front of them, and they're not seeing. And you know what is the best sign for me? And that applies to any stock market in the world. Ask any CEO in any stock exchange to tell you the statistics of how many listings have they lost in the last 5 years. And what has happened to the liquidity, not in times of crisis, but in normal times, what has happened to liquidity in the stock exchanges? And what they're failing to see is that because they're not transforming, and I'm part of the World Federation of Exchanges as a partner at Consensus, and what and I'm trying to tell them that to wake up. And what they're not seeing is that people are going to vote with their feet. And the simple way is that the money will follow a system that is frictionless, borderless. It has an audit trail. It reduces cost. It has a complete audit trail. It has new instruments that you can invent, like the tokens that Henry has got on whiskey tokens. You know, you can tokenize absolutely any asset. You can bring liquidity to assets that never had liquidity, the concept of fractional ownership, and what that's going to do to the mutual funds industry. And to deny this is because the change between the traditional stock market and the security tokens is a complete paradigm shift. You really have to give up most of the control of what you've been doing for 100 years.
What I think is very interesting to see is you're starting to see this fabric, which is, blockchain, consensus layers, etc., starting to tap into different tool sets where you're seeing issuance platforms, liquidity venues, we're seeing, a secondary market appearing, we're seeing derivatives, things like that. But it is that stitching together that infrastructure is doing to these different exchanges, where you're getting almost a zero cost or near zero cost infrastructure almost available outside the box, which I simply couldn't get access to if I wanted to go and list something today. So Arthur, I'd love to kind of bring you into this point to talk a little bit about, Tezos and, to what extent do you think people kind of gravitating to Tezos for kind of tokenization kind of capabilities and the ecosystem you're building? I'd like to hear a little bit more about, Tezos and some of the things that make it unique, such as the governance.
Yeah, I think there's several advantages to the technology in Tezos, perhaps for those use cases. One is that I will say that I think the chain has been the product has been fairly security minded in its development and its coding practices. Smart contract languages that you can use for Tezos. There are frameworks for doing formal verification of the contracts, and obviously you can do that with any language, but I think they are easier to manage when you're dealing with Tezos, and also the fact that there's some a method of governance on the platform is basically something that it gives you two things. One is that It's an indication of longevity in a sense that you don't have to become obsolete. And right now, I would say previous blockchains have even chosen to not care about obsolescence by saying like, no, we got the design right on the first go, and we're never going to change anything. Or they're going to rely on a very ad hoc governance process, saying like, well, we'll kind of like, we'll update our software all at the same time. We'll coordinate to do that. And so there's no credible plan for upgrading and keeping up to date on the latest technology. And I think what people are interested in Tesla is that it was one of the first chain to actually propose that, and now there's a new wave of blockchain, and they all like are trying to think of governance in some ways. But I would say that the product really introduced the topic and put it at the forefront.
It's certainly challenging to upgrade decentralized networks because, by definition, they're decentralized. It's a design choice that has to be made as part of that. So it's interesting to hear how kind of Tezos has taken a very interesting approach from a kind of governance perspective there. So I wanted to turn the conversation a little bit more around. We've talked about some of the overall demand. We've talked about the context of digital assets. We've talked about some of the infrastructure and the fabric. I'd like to now kind of turn to a very specific and very timely example of a fund using the blockchain. So specifically the tokenized bourbon whiskey that Henry and his team has been working on at Y Financial. I have to be very transparent here. I wrote an article for Forbes.com a while ago profiling this. I think it's actually a very good use of tokenization technology. But Henry, I'd love for you to explain, just kind of in your own terms, a bit more about the fund, the thesis around it, where you are in the development of it, and why blockchain.
Certainly, and thank you for your support. I'm glad that you like the fund and the application. We came at this from the perspective of, how can we take this technology and apply it in a way that is as impactful as possible? And so there are a couple different metrics that we had to think about. And the first one, of course, was what asset class should be the first one that we jump into. My own background is in real estate, and I was trying to tokenize real estate in 2018 and 2019. And so obviously, I had a sort of a natural instinct to say, well, let's try again. Now it's 2020, the market's matured. Let's get some real estate on the blockchain. But one of the fundamental issues with that is that, the power of tokenizing an asset is potentially increasing access to that asset class as an investment. And real estate is not really an asset class that wants for access. Once upon a time, it was quite difficult to scrape together all the money that you need to be an LP. But now you have a number of different websites, crowdfunding websites, that can fractionalize down LP positions into a small enough amount that virtually anyone, at least in Western society, can invest in them. So that sort of took real estate off of the table. We thought, all right, well, alcohols are very interesting. Everybody understands alcohol. Most people drink alcohol, and the value proposition is there. So why not wine? But wine is a little bit difficult in that it depends on the vintage. So you could take a 2005 vintage that's worth more than a 2003 vintage simply because 2003 was a bad year. And so what's to say that our 2020 vintage wine doesn't end up being the worst year, in the last 10 years? And it's an uncontrollable factor. And so then we sort of fell into, this was actually not even a market that we realized existed, which was the barreled, barrels of bourbon market. It's not something that most people realize, but when a whiskey manufacturer actually puts the whiskey in a barrel, they typically don't hold that capital asset on their balance sheet. They want to put that money back to work, either buying back aged barrels and selling them retail, which is where they make most of their spread and their profit, or on building more facilities to store more whiskey. And so there's a very small unknown market. It's actually not that small, but there's a very unknown market for investors who want to buy those barrels of whiskey and basically hold them for the 4, 5, 6 years that they're aging. And then at the end of that time, you can sell it back to the whiskey company, to the distiller, and then they'll go sell it retail. But you gain the benefit of the value appreciation that's inherent in the aging of most dark alcohols. And that value appreciation is very quite significant. Typically averages almost 20% or higher on an annual IRR metric. And so we spent some time. We had a couple people join our team who actually had connections to this particular capital market. And we spent a lot of time in Kentucky and met a lot of people. And we actually got an allocation of 25,000 barrels of 2020 production from a very well-known distillery there, and put that into a fund and tokenized that fund. And by doing that, we basically allowed the investor to shorten their investment horizon. And we also allowed it to be fractionalized in a manner that made it more accessible to a wider swath of investors. And so now you can invest in this asset class. You don't have to be holding it for 5 or 6 years. You can hold it for 2 years, and you can simply sell the token on to another investor who wants to hold it for the next 2 years and gain that 20% IRR.
Now, what I like about this use case, and I know, Henry, I've had conversations with your team before, is there's been a little bit of this kind of mania of tokenize everything. People talk about, housing and real estate and all kinds of things. And a lot of times when you kind of double click into it, and you say, well, is this allowing you to get money where you wouldn't be able to get a bank loan? Yes or no? Is it allowing you to do cap table management more easily than you could before? Is this allowing you to access pools of liquidity you couldn't before? A lot of times in most use cases I've seen, the answer is no, maybe. It's very kind of unclear. I think part of that is that rush to tokenization, because kind of the buzz of tokenizing the St. Aspen Regis gets the marketing kind of folks involved, and there's a buzz. But then after that, you end up finding out that these products, you can't actually trade them in the secondary market. There's no liquidity, and you have these kind of problems. So I'd love to actually hear from the team. I think maybe kind of Sheila, kind of Monica and Arthur, and then yourself, Henry, is a bit about this whole elephant in the room around liquidity. The markets are generally thin when it comes to security tokens. One could say that's because we're early in the adoption, and therefore we are unlikely to get people to come necessarily. It's just the hardcore early adopters. But if you look at platforms like T0, they only have 1 or 2 coins. They've been going for some time. Open Finance is just asking token issuers to relist all their tokens for an additional fee. We're seeing challenges around liquidity and adoption. Now, is that going to be solved anytime soon? I'd love to hear your thoughts around some of that. I'm starting with Sheila and kind of Monica and Arthur.
Oh, sure. I can certainly go first. I think that certainly what we're seeing right now is that this is still a bit of a novelty play. There's a novelty to kind of fractional ownership of certain kinds of assets that you wouldn't otherwise be able to own. It's a bit of like a NetJet, kind of phenomenon, right? Where you don't have to kind of hold the entirety of the thing. And certainly I think that's as fine a place to start as any. And I think that the sort of secondary markets are going to be developed around this sort of relatively elite, sophisticated class of individual or of entity that can kind of engage in this market and understands intuitively or literally why this is exciting and what the ROI is here, and is not overly concerned about the time to liquidity that may elapse in certain kinds of assets being fractionalized or being tokenized. What I think is more challenging is really when we, again, putting it back in light of the times we're in and thinking about economic recovery, thinking about stimulus loans to small businesses, thinking about the real need for capital raise right now and where that is in society is at a different level. It's at a different level of engagement. The need is much more acute. The need for liquidity is deeply, deeply held. And there isn't sort of a time horizon that a lot of these small businesses or shareholder farmers or whatever use case you want to kind of engage with, they don't have that. And so I do feel like I worry rather, this is going to yet again wind up becoming a very stratified asset class. And we're going to build to what the current interest is, which is again, this kind of more, I don't mean to say novelty dismissively. I think this is where it starts. This is as good an experiment as any, right? I don't mean to in any way suggest that that's not super legitimate and valid and important in its own way. But I do think that I worry that the infrastructure is going to remain at that level, and we're not going to be actually building an infrastructure that's going to be accessible by a lot of the members of society who desperately, and I use that word deliberately, who desperately need access to capital that they just can't get. So I think it's a really good point, Ben. I think that we do have to think about the realities around liquidity, who generally has access to these kinds of markets, who can actually hold and accept the risk, and who can't. But I'd be really curious to hear what Monica and Arthur have to say as well. And Henry.
So one project that we involve, Consensus, is called Liquid Shares. And the whole object is in Europe. And the whole idea is that in Europe, there are more private companies than listed companies. So like Sheila was saying about the SMEs, it's about trying to bring liquidity to the private companies. So instead of like creating another board and bringing the private companies in a semi-public environment in the legacy technology, you create the ability for the private companies to be traded, cleared, and settled real time, with no friction, with no intermediaries, with all the benefits that this new technology brings. So slowly but surely, you start getting the market and the investors used to it. Because the other thing you mustn't forget, in Europe and the US, the investors are still not able to have their identity on the main register. Their name is behind a nominee of another nominee of another nominee. And by all the legislations in all these markets, those investors are not treated as shareholders. They have to rely on the custodian bank to give them all the benefits, to pay them the corporate actions. There are massive delays, there are problems, there are reconciliation issues. And the poor investor never gets to have a complete database information of their investments. If they put their stock with different brokers or different banks, God help them. So, and don't get me started about the listed companies. The listed companies need to know real time who's buying and selling. That information is not available. Why? Because try to get the information from all these nominees involved in the market. So when you look at this and you have to look for finance, why would you ever want to list on a traditional stock exchange when this new technology will give you an ability to achieve things that were never possible? And that's why I left the company I ran for 20 years, the Digital Securities Depository, because when I read Satoshi's paper, I thought, the world is going to change and we're going to make a change. And the value that the Central Securities Depositories add today will not be needed in the future. And therefore, why would I sit in the Titanic rearranging the chairs? Let me go and work in the new world and bring this new technology, because it will happen.
Interesting, Monica. Really interesting. I do wonder to what extent a lot of the world started out like this, but ended up in this kind of very perverse situation where you have Eden Company in the US that owns all the stock and will own rights to it, because of all the regulation that kind of forced it to that point. You know, I think one of the good things about kind of where we are now in digital securities is where, to some extent, we've been able to roll back some of that, but I wonder how much we get pulled down that route. But Arthur, I wanted to turn to you now, and kind of also going to pose the question. I know kind of your answer is probably going to be a little bit more from the kind of the infrastructure kind of consensus kind of side of things.
I mean, I did work for 10 years as a market maker, so I'm happy to talk about liquidity.
There you go. So I won't put words into your mouth, Arthur. I'm sorry. I'd love to hear your perspective.
Yeah, I would say basically you have three aspects to this liquidity problem. There's a technological aspect, there's a volume aspect, and there's an adverse selection aspect. And the technology aspect is it's the easiest in some sense. It's the least problematic. It's true that if you lower friction, you can maybe get some liquidity. Like Monica was saying, if instead of having layers and layers and layers of centralized ledger, you just put everyone on the same ledger. It's you cut through a lot of things. You can deploy matching engines. You can build order books. You can do all of that, and certainly that will help liquidity. But it's only I would say like the tip of the iceberg. And the main problems, if you have this very long tail of assets that you tokenize, is that they're going to have they're not going to have a lot of volume, and they're not going to have and they're not going to have a lot of transparency. If you're looking at publicly traded company today, you have tons and tons and tons of information. There's tons of analysts covering it. There's a tremendous amount of eyeballs looking at these companies and knowing exactly what's going on. And that's important because as a market maker, basically, you make money when people trade against you. If people buy and sell, if there's a lot of interest, natural interest for buying and selling, then you're going to collect the spread as a market maker every single time you make money. You stop making money when people are trading with you, not because they want to own or because they want to sell, but because they know something that you don't. That's when you lose money as a market maker. And so any assets that kind of like kind of small, so there's not a lot of eyeballs looking at it, there's not a lot of people naturally wanting to trade it, it's a terrible deal for a market maker. And as a result, you're going to hit lower liquidity. And building a better technological stack that can help, that can be a part of the solution, but it's not going to be the full thing. And if we want to find technological solution to this problem, I would say that probably the most interesting path is to build technological solution which will help with the transparency of these companies. So for example, if you're looking at technologies which can make the accounting of a company, for example, or technologies which can prove whiskey reserves, so, put in place technologies for making it very, very easy to audit what's going on. And if you have that, then that can bring more liquidity.
There's another, so in 2018 and 2019, when I was trying to tokenize real estate, what we found was that there was quite a bit of, there was a lot of difficulty in terms of illustrating the value proposition of tokenizing the asset, because you went to the asset owner and you said, all right, we're going to tokenize this. It's going to add all kinds of liquidity. It's going to be amazing. You definitely want to do this. And then they would say, okay, cool. Well, I want to understand this technology. Can you please show me where this liquidity will come from? And there was nowhere to show them, right? So you were basically saying, take a leap of faith on this technology. I can't yet prove to you that there's an actual value proposition here today. And then in 2019, when the sort of the hype started to slow down and the speculators left the market, the builders and the entrepreneurs stayed. And they looked at that value proposition and they said, all right, how can I increase that proposition upfront so that I'm not just relying on the liquidity, which is not yet there. And so you see groups like Invenium Capital, which are trying to build the pipelines, the data pipelines from the issuer of the security to the investor, so that the investor, no matter how many layers are between them and the underlying asset, can see that data directly. So it's sort of like what Monica was talking about, how it's very difficult for the individual investor to find data on the underlying assets that they're actually buying into. And this is the same issue that we saw in 2008, where investors were buying, investment products where they had absolutely no idea what was underlying the actual returns of that product. And so if you can use blockchain architecture to create this direct data relationship between the issuer and the end investor, you start to create a lot of value on the front end for both the issuer and the investor. So you do start to see a lot of the entrepreneurs in the space starting to solve that issue right now and moving that value forward so that you can see it today.
And can I say something? That let's not forget why Lehman went under, because on the critical week, they couldn't come up with the exposure that they had. They couldn't. It took 8 years of auditors and accountants to put this together. That should never happen. And that's why Satoshi wrote the paper to say, what? We need to invent something that the trust is built in the computer and not rely on people, because the system doesn't work when you rely on centralized authorities. And that's why auditing will change, and lawyers will change, everything will change, actually. And I think that this virus is the best thing that ever happened, because it's going to force us all to take stock as to what we have been doing that is not working.
Yeah, interesting. Where when does the panel think we'll start to see kind of mass adoption of digital instruments? And by that I mean it could be central bank digital currency, it could be funds that are tokenized, it could be pieces of art that are tokenized. I'm going to go around the kind of the horn quickly. So starting with you, Sheila, where do you think we'll see that first?
In terms of where we're going to see mass adoption first? I mean, I think we're going to see it in sort of digital assets. I think it's going to be where the psychological leap is the least burdensome. And that I think is just in the payment space. Most people are making digital payments every single day. They don't really think about it much. So anything that's basically a back end that modifies digital payments, but the front end doesn't change much, I think you're going to see mass adoption or sort of invisible adoption of that. Because again, there's not a big change to anyone's sort of MO or their way of doing business. So I just think from a sort of what's the hurdle you have to jump? There are the fewest hurdles in many ways there from an adoption perspective. I think the regulation is a very different question, but I don't think that's what you asked. So that's what I think. Yeah.
You know, it's really interesting because Monica brought up a point about how building this new securities infrastructure on blockchain is, it's not necessarily a evolution so much as it is a revolution. We're going to tear down the old, build the new. But yet, nonetheless, you see a lot of adoption coming from the DTCC and other existing intermediaries who are afraid of exactly what Monica was talking about and who are now looking at this technology to potentially future-proof themselves and may actually end up just, disintermediating themselves as they drive adoption.
They don't have adoption.
It's interesting that the infrastructure point. I mean, I was talking to head of digital assets for a large broker-dealer, international bank broker-dealer. And they said, look, we can actually shave 95% off the cost of issuance trading for life cycle. Right. Pointed to situations like HQLAX, which is a way that you can actually swap assets without having to go asset to cash to asset, which breaks all kinds of models from margining and things like that. And we've also had the announcement from R3, I think this week, that they've just paired up with NASDAQ to start having Corda introduced into the infrastructure. So it's interesting to kind of see these kind of large institutions starting to kind of use that kind of fabric. But I'd love to kind of hear from the panel, are we going to see almost kind of a two-track approach where you have a slightly more, I guess, anarchistic aspect where you're trying to build this parallel ecosystem that is very much kind of unregulated and sits outside, and this next track, which looks more like the DTCC settling assets and things like that? Are we going to see the singularity? Are we going to see it combined? Love to hear the panel's thoughts.
For me, it's a parallel track. So eventually you will see that, like, for example, the DTCC depends on the volumes of the exchanges. So if people are not listing on traditional exchanges, their revenue will dry. And therefore they have no other option but re-engineer themselves. And I don't know if everybody knows, but there's one CSD in every country in the world, and they're all facing the same dilemma. But the truth is that the CSD, which is the Central Securities Depository, in this new world order, if they don't re-engineer themselves, they are not needed. If you are vertically integrated, if the stock exchange owns the CSD and the central counterparty, they can very easily collapse all these legal structures and just have the ability to trade and settle real time. And it's the internet. This is not a mainframe. This is not Swift messages. There's the internet. There's no borders. Can you imagine? And then because of the standards that we built in, those tokens, security tokens that are traded, let's say in Europe, will be atomic swap with any other security token traded anywhere in the world. And that's, you're going to sit in your toilet with your finger in an app, doing swapping tokens. You won't phone a broker, you won't phone a bank, you're going to control your own portfolio when the user experience becomes, more user-friendly. But trust me, that's what you're going to do in the New World Order.
And we'll be swapping them on the Tezos blockchain, right?
Of course.
Well, if it's all on one chain, you won't even need an atomic swap. That's the beauty of it.
Exactly. Even that.
Even faster.
Yeah.
Also, what are the plans for kind of Tezos with respect to kind of digital assets? Are there particular aspects that you're putting your time and attention to, whether it's the connectivity to liquidity pools, issuance platforms, more about kind of ERC20 style kind of aspects? Is that kind of an area of focus for you guys at the moment?
No, I'm not. I mean, I'm not really focused on that. Tezos is a blockchain; it's a piece of technology, so it doesn't do any of that.
Nope, fair enough. And now, kind of Monica, obviously you're deep with Ethereum, and there are emerging standards, whether it's ERC20, ERC1441, ones which are aligned with the Delaware kind of rules coming out. There's also been a couple of backdoors that have been exploited with some of them. I'd love to kind of hear kind of where do you think kind of Ethereum is in terms of providing the infrastructure that you need to go out and convince your clients to use it? Is it there yet, or does it still need to be evolved?
I think, you know what, it is there, but it still needs to evolve. But the main thing is that we are very much investing time and energy and technology in the enterprise Ethereum. And therefore, we are, at the beginning, we thought, okay, everything should be in the permissionless public mainnet. But now we realize that in the same way that the internet, when it was invented, I don't know if you can remember, but nobody was sending emails in the internet. They were sending emails via little intranets. Everybody was scared, you know? So the same is happening today. We realize that we cannot, you know, people cannot cope with so much change. And we're talking, remember, the decision makers are not 20-year-olds. They're 50-year-olds that cannot even begin to comprehend this technology. When I present to them, they say to me, I'm going to retire before this gets implemented. And then comes a 20-year-old looking at this and said, guys, what rubbish is this? I'm not going to use the legacy system and stand in a queue or wait for the stock market to open. No. So do you understand that we had to go back as Ethereum and said, okay, how do we accommodate it? Because think about it. What is Corda doing? Corda is really not doing what is ideal, no? But it's gaining clients in the enterprise side because they're accommodating the old world order in their thinking. They're not going against it. So do you understand? Sometimes you have to go with the flow to get, you know, the flights, they go, when they have to go from, let's say, Johannesburg to Sao Paulo, it's not a straight line. It goes up and down, depending on the wind. And then this is very similar what we will have to do to get to where we know is the ideal state for financial markets.
You know, I'm going to push on that a little bit, though, because I think based on who, you know, we talk to a lot of these 50-year-olds all the time, right? I mean, this is kind of the crowd that we engage with a lot, in addition to, of course, actual blockchain experts. But I think that it's not so much, I would say, that they aren't open to this or they don't really understand it. I think there's a lot more awareness than I think is commonly known. Certainly post ICO, I think during that period there was a lot of dismissiveness of the space for reasons that I think are probably pretty obvious. But I think we've really moved quite a bit from, you know, over the past couple of years. But what I think we're seeing is that we're not set up to reward that kind of behavior. I mean, that's the problem. These kinds of giant risks are not palatable to a lot of shareholders and boards and things like that. So even when leadership, I think, is super motivated to get there and recognizes that this is the way the world is moving and that they really have to get on trend, you know, or their business is going to basically vanish. There's a lot of resistance that's built into this system, and that friction, I think, is really challenging for a lot of companies in the space.
That's great, Sheila. I think going back to some of the points we talked about R3 and Ethereum, you know, implicitly what we're talking about here is a couple of different philosophies. One which is a closed network philosophy that looks a lot more like a shared database between institutional organizations, and another one which is a public network which is available to anyone, you know, no cost of setup or low cost of setup. Anyone can participate, but then again, you have some kind of challenges potentially around adoption of standards. And I'd love to hear kind of your thoughts around the public versus kind of private kind of blockchain divide as it pertains to security tokens. I think probably initially kind of Monica and Arthur representing, I guess, the public aspects of the technology, and then obviously kind of Sheila and Henry. I'd love to hear your thoughts more generally.
Arthur, you go first.
Sorry, I was hoping you'd go first because I couldn't quite get the question.
I'm sorry, it's probably the British accent. No one can really understand what I say. At least all my wife. It's probably why we're still together.
I suffer from the same affliction.
So I was talking a little bit about the public versus private infrastructure debate. You know, is the world going to be all these private protocols like R3 that's connecting, or Symbiont that's connecting to institutional providers? Or will it be these public protocols because they have the ability to pull in more people and more institutions without setting up consortia? Or is the world going to have both, where it depends on certain parts of that value chain?
I think it depends what you're trying to build. If you're, you know, trying to do an overhaul of the IT system of the DTCCs and maybe using a private blockchain is what you might want to have. It's kind of like it's a more auditable database. So if you had a database and you want a more auditable database, you can have a blockchain. It's a little better than that, because if also you have a group of people, some consortium, and you want to solve the political problem of knowing, like, well, who's going to run it? I know no one is going to run it, or rather everyone is going to run it, and no one is going to control it. Then basically you can cut the baby and just say, like, okay, we'll have like some distributed way of maintaining it. And this of course, there's an overhead to all of that. There's a cost to all of that. So I think we'll still see some private blockchains for this type of application. But to be honest, where this is most interesting is it's when you go on a public side, because immediately you have this cross-border aspect. You have the fact that it's there, it's available. You don't need to convince your entire consortium to do something or something else. You're in a permissionless setting, so you can have a lot more innovation. You can have a lot more interaction with other things. And so, while in theory, I often say that the point of public blockchains is public decentralized blockchain is censorship resistance. And it's true that for some of this product, maybe you don't care that much about censorship resistance, because at the end of the day, the titles you have, they are centralized in some sense. And so why would you care so much about having a decentralized chain? And I think it's not the benefit you have is not a first order effect. It's more of a second order effect of the fact that there's just more happenings, there's more technologies, there's more interesting things happening on the public chain in general.
I fully agree, but I also want to add that I don't know if you heard the announcement by EY saying that they are able to now achieve security and controls in the public permissionless ecosystem. So that means that more and more people are going to start getting used to this using not going into this little private environment, because 100% what Arthur said is correct.
Interesting.
Yeah, I would add the flip side of like any title, like if you have a share in a company, for example, or a title to a piece of whiskey, for example, these are not really bearer assets. And so in some sense, you might say, well, since they're not bearer assets, they don't necessarily need to be on a public chain. But it's also true that the downside that you might see on a public chain will also not affect them. So it goes both ways.
Yeah, I agree.
No, that's very interesting to have that perspective. It sounds like it's going to take a little while for digital assets to truly take off. One of the ways that it was described to me in terms of an ultimate kind of goal by someone from an organization called Dowra, which is like a little mini printing press for kind of mom and pop shop organizations that want to issue equity. And they said to me once, imagine you go to a ski resort and you earn a tiny bit of micro equity. It could be $20 worth of micro equity in that ski resort. And because you have that, it's on a QR code, which you can use to scan on the lift, to go up to the top of the mountain. And that allows you to have VIP services. It recognizes you. And you have this kind of stake that's frictionless in that. And you haven't had to worry about custodians, have to worry about all the regulatory issues. You're probably not even going to sell it on an exchange. I thought that was kind of quite interesting, because it talks about the kind of ubiquity of owning aspects of an organization, in particular, Sheila, where you're sitting from the World Economic Forum. There must be so many organizations like that, as you said before, need to get access to capital. And there must be so many that want to participate in like this new stakeholder economy, where they want to have some kind of stake. If you look at Mexico, where the land prices have increased so quickly, yet the people who are not getting the value aren't the people who live there. They are the people who are building all the apartment complexes. So I'd love to hear your perspective from that kind of that part of the world.
Yeah, I think this is certainly the case. I mean, I think real estate is a great example, as you're seeing the price of ownership just really floating away from people in parts of the world outside of the sort of major urban, centers. And it's now a reality. And already the models are such that you're working on borrowed land, if you will. You're tilling borrowed land, or you have some kind of sharecropper kind of model. And that's a very common model. It's with mines, it's with teams, it's with farms, it's whatever it is. So I think we are seeing an increased understanding, and it's particularly true in sub-Saharan Africa. We're seeing quite a bit of activity in this space, and parts of ASEAN, where you're really seeing this notion that you can provide that stake. You can actually give at least fractional ownership to this kind of small proper kind of, situation, where there'd be an impossibility for them to kind of pool together, which was the other option, was kind of create these big kind of pooled funds where you could kind of collectively own. This provides that without the governance issues, without the kind of potential for fraud or other things, like criminal activity that could kind of happen. So yeah, I do think that the notions of what makes tokenization interesting are very different depending on the market you're talking about, depending both geographically, because the regulation is obviously a huge elephant that we've hit upon, but not hit directly. But it's a huge issue in terms of what you can and can't get away with right now in this space. But also, I think where the adoption is going to be driven from.
Can I say something? Okay, so the other aspect that we haven't covered, and I think is essential, is, as you know, because of what's happening with Facebook and Libra, there has been quite a flurry reaction by the central banks to consider central bank digital currencies. Please just take your imagination down a couple of years into the future. Let's assume that many people, citizens in the world, will have their own wallets with this currency, which is in the ledger of the central bank, totally secure. They're going to get used to using a new wallet. And then what stops them from saying, what about putting in my cell phone applications, whatever, security tokens of any sorts? Because once you introduce to the man in the street this functionality, they're going to start saying, what else? What else? Loans. So that's where the world of DeFi will come. And it will become totally acceptable, because the paradigm would have changed. And already, I'm sure you've been reading many providers of stable coins and many even cryptocurrency exchanges. They're saying, wait a second, if I can do this so efficiently, why can I then not do other things also very efficiently? And some of these cryptocurrencies have got enough money to actually invest in these other products, services. So I really feel for the legacy technology. I think if they don't do something, their liquidity and number of listings will start drying up completely.
Great. So I think we've got a couple of minutes left now. So let's just do a kind of a quick kind of a round robin. Just going to get some of the closing kind of thoughts and remarks. I mean, I'll start. I think it's been a great discussion. I think that what you're seeing here is, we're in the foothills of what could be incredibly powerful in terms of a real transformation. If you look at when Bitcoin was started, it was during, the last great recession when many people felt that they were getting a very bad end of the deal in terms of, the banks who were consolidating a lot of power. This could be, the turning point where we start to see some of that adoption, because, people are beginning to look through some of the challenges of some of these centralized organizations. So obviously there's a lot to do. We have thin liquidity, we have products that are hard to really describe, get their hands around it. UX is still not very good. But with talent that we have on this panel today, I think that we've got a lot of opportunity here. So we're going to have Sheila, Henry, Monica, and Arthur. If you're going to give us a couple of closing kind of comments, and then we'll finish for today.
Sure. I certainly agree with everyone on the panel in the broad, the most macro frame on this, which is that this is coming. I mean, this is really real. The acceleration is really, I think it's abundantly obvious. I think the pandemic is going to push things even forward. I think we kind of started with digital payments, and that kind of shift, that sort of front end, if you will, shift, that paved the way for digital currencies and CBDC in particular to kind of become a little more normalized and become something that we're now seeing a lot of engagement with. And that is going to quickly move into Monica's last point. I think we're going to see digital security tokens still as this kind of thing is going to, again, that leap is not going to be as significant because it's just going to seem really natural to engage in this fashion. And why wouldn't you then immediately kind of engage in other activities that that you'd want to do in this through the same sort of mechanism? So it's coming, it's coming fast, and agree that we all need to be paying a lot of attention and really get ready if we're not already.
Henry, do you want to go next?
Yeah, I think especially over the next 12 to 24 months, it'll be really interesting to see as more companies and tokenization platforms try to tackle the problem of tokenizing direct ownership. Pretty much everything that we see right now is tokenization of an ownership interest of a corporation that owns the underlying asset or some sort of a corporate structure. We haven't yet seen the actual tokenization of a direct ownership interest, which opens up, particularly in the real estate world, a lot of very interesting transfers of ownership in terms of 1031, like kind exchanges, and moving your tax basis around, stuff that you cannot do with securities. And so that's something that I'm just incredibly excited to see people tackling, going forward.
Great. Monica?
For me, the issue we haven't even raised, which is education. We in this panel and the people attending this conference get it. But the only way that this is going to become acceptable is when, I'm sure you know that 20 years ago, people didn't want to send emails. Who can go to work without a computer today? No one. So when we start educating absolutely everybody, starting from children and old people, how to use this technology, and we make it so simple, then you will see the implosion. It's all about education.
And Arthur, you've got the last 20 to 30 seconds, so you get to wrap up the whole panel. Final word on the matter.
So I will say that in digitization of assets, there's kind of a spectrum, and at one end of the spectrum you have, let's put our capital on the blockchain, and then if one of the if one of the holders wants to transfer their shares, there will be a single party who will sign a message and send it to the blockchain, and that's pretty useless. And then the less and less permission, the more and more it starts looking like a bearer title. I think the more it's interesting. I wonder if we're going to see something completely closer to a cryptocurrency. In the sense of being a bearer, a bearer assets, saying hey, you know what? I own this barrel of whiskey, and I have a token, and whoever has a token can redeem it. And it's not tied to your identity or anything like that. You just own this barrel of whiskey. And so seeing things at the other end of the spectrum, I think would be cool and interesting. I don't know. There's probably some challenges associated with that. I'm just thinking from a economics perspective, it would be fun.
Great, thank you so much, everyone. Some fantastic perspectives in the panel. So I want to thank Sheila Warren, Henry Elder, and Monica Singer, and of course Arthur Brightman for your time today. Thank you very much, everybody.
Thank you, everybody.
Bye.
Bye.
Bye.